What's the secret to deal making today? Match the ideal buyer to the perfect seller. It's that simple. The hard part is always been how. I'm Doug Cullen, Chief Product and Strategy Officer at DataSite. In this webinar hosted by Harvard Business Review Analytic Services, our expert panel will explore how technology can answer that question. Thank you to the panelists, and thanks to all of you for coming. We'll make it worth your while.
DataSite, the digital home of M&A. With you every step of the M&A lifecycle. DataSite, where deals are made.
Welcome to today's Harvard Business Review Analytics Services webinar, Managing Complexity in Tech-Driven M&A. I'm Todd Pruzan, Senior Editor for Research and Special Projects, and I want to thank all of you for joining us today. And I want to thank DataSite for making this webinar possible. Mergers and acquisitions, or M&A, have long been a complex business practice, but two aspects have always been integral to a dealmaker's success: speed and knowledge. And having the competitive advantage in these two areas gives organizations leverage in their M&A deals. While M&A activity is growing and is expected to continue to rise, dealmakers are finding themselves increasingly in need of data insights as they also look to improve the efficiency of the M&A process. In today's webinar, Alex Clemente of HBR-Analytic Services will explore insights from a recent report on key trends affecting M&A. He'll then talk about M&A innovation, highlighting those areas where the best teams are gaining advantage, with Mike Beregovsky, President and Chief M&A Officer at Allied Universal, and Lukasz Dziarnowski, Managing Director and Head of M&A Sell-Side Practice at BNP Paribas. The three of them will share their perspectives on this report, and they'll talk about key trends in M&A, how companies are using data in the M&A process to increase valuations, the role of digital tools in the M&A process, how technology is increasing the speed and efficiency of M&A deals, the role of environmental, social, and governance, or ESG culture in M&A success, and what the future of M&A looks like. As a reminder, this webinar is being recorded, but we are live, and this is an interactive webinar. We'll even have a couple of survey questions in a few minutes. So if you have questions or comments at any time, just type your question into the Q&A chat box. If you would like us to ask your question anonymously, please let us know that. And if you need help at any time, click on the yellow question mark help icon. Mike, Lukasz, thank you so much for being with us today. And Alex, let's start with you so you can provide us with some context from the report to set the stage for our discussion today.
Yeah, thank you for that introduction, Todd. And I'd also like to thank DataSite for sponsoring the body of research that we're presenting today. When they approached us about conducting this project, we thought that given the disruption caused by the pandemic, it would be interesting to see how M&A might have been impacted like so many other aspects of business were. And while the pandemic did change the order of many organizations' growth strategies, the longer arc of digital transformation has been set in motion years before the COVID-19 outbreak. And what we reveal in the report is the need for speed, particularly in the area of due diligence, as a way to establish a competitive advantage. And as mentioned, the transformational wave of the past decade is really increased capabilities around data and analytics based on new digital technologies. And these capabilities are now evident in everything from customer service to product pricing to supply chain visibility and procurement. And now M&A is getting into the data-driven transformation, quite frankly, as it should.
Okay, Alex, thank you for the overview. It's time for a survey question. We want to start with one question. It should be appearing on your screen. You can take a few questions to answer it. The first question is, which social, political, or economic factors do you expect most to affect deal making in 2023? Please select among international military conflicts, talent shortages, recession fears, inflation, antitrust efforts, supply chain risks, or cybersecurity concerns. You can take a minute to answer that, and then we'll get to the results. Okay, so let's see what came in. And it looks like by a long shot, recession fears, almost 2/3 of respondents feel that that is probably the most important factor to affect deal making next year. Inflation comes behind almost 1 out of 5. Alex, you mentioned the pandemic. Are the other factors affecting M&A right now? Obviously, recession fears, inflation, much on people's minds.
Yeah, I mean, the report that we, in our report, what we included was a mid-year study, some data from a mid-year study that DataSite conducted of more than 500 M&A executives. And that study was done in the first half of the year. So keep in mind, we're now in November. But in that particular study, the dealmakers cited the Russia-Ukraine conflict, followed by inflation and rising costs of capital. ESG, which is environment, society, and governance, supply chain risk, and compliance with national security and antitrust regulations as the top 5 factors impacting M&A at that time. So, looking at what we have here is from this audience is recession fear. Certainly, the recession, the volume of the recession has increased certainly since May or June timeframe. But including that, there's some strong macro forces at play in addition to the pandemic. And then, of course, the challenge of M&A itself in an uncertain environment.
Okay, great. Thanks for that context. Yes, a 6-month difference is a pretty big difference this year. Survey question number 2. Which types of deals do you expect to see more of in 2023? The options are transformational M&A, debt financing, secondary buyouts, divestitures, carve-outs and exits, fundraising bolt-ons, IPOs and SPACs, or liquidation and bankruptcy. So let's wait for those results for a little bit. Okay, and let's see how the answers came in for this one. Okay, again, about 2 out of 5, 42% said divestitures, carve-outs, and exits are something that people are expecting to see next year. Transformational M&A, liquidation, and bankruptcy; those both are also kind of leading predictions. Alex, based on the research, what kinds of deals will we be seeing this year? Are they different from what came in the survey?
Yeah, I mean, going back to the study that DataSite conducted, transformational acquisitions was actually the number 1 type of a transaction, and an example of that would be a brick and mortar company, let's say, acquiring a pure play digital company in order to acquire their technical capabilities as well as their technology itself. Other top deals that were cited were debt financing, secondary buyouts, again, divestitures coming in 4th or 5th, carve-outs and exits, and fundraising. Again, this was a study that was conducted about 6 months ago, so we absolutely expect there to be some change. Those are the top 5. What was interesting to me was in the DataSite study, liquidation and bankruptcy was actually at the bottom of the list, but 6 months later, we're kind of coming more into this impending global recession, and we see actually, I think it was 20%, the bottom of, 21%
yes.
Here. I would expect that number probably to rise as well.
Okay, thank you for that. Last survey question: where do you see M&A valuations headed in 2023? The selections are increasing, decreasing, remain the same, or not sure. A few seconds to answer that. Okay, and the results. So it looks like everybody says decreasing. That's not a huge shock. That makes a lot of sense. I think this is what I think we're all seeing the same thing right now. I want to start the panel. I want to start with Lukasz Dziarnowski. from BNP Paribas. Lukasz, how does your company use technology in M&A today that's different from how you may have once used it? And what benefits does technology bring you in M&A?
Yeah, and thanks for having me. It's a really great opportunity. I'll put my answers in a slightly different way because I'll try to present it how my clients use it, because I advise companies mostly on sell sides, but also on buy sides in M&A. And I think the technology has definitely come into M&A, and it's getting more traction. And I agree with the earlier statements that it's there to improve efficiency and speed. But also, I think what we see now is to increase the quality of due diligence because it's mostly focused on due diligence. It's people are with the technical tools that they have, in the same sort of time frame, they can dig deeper, they can run more detailed analysis, which I would think leads to better decisions and better due diligence acquisition targets, which might also lead to more accurate valuation. So clearly, due diligence is probably the key aspect of that. And another aspect of technology being used in M&A, and that's what the pandemic brought, is ability to sort of disintermediate and from some physical meetings. And I did deals in 20 and 21 without seeing the other party at all in reality, in real life. So everything can be done now over internet and virtually.
Great, thank you. I want to turn to Mike Beregovsky from Allied Universal. Mike, how has M&A changed for your company in recent years? And are you seeing any new trends around the role of advisors in particular?
Yeah, certainly. So for us, the biggest change in acquisitions came with the acquisition of G4S last year and entry into the global market for us. So we've done over 90 deals in a decade or so, almost exclusively in North America, which was the focus of our M&A strategy. With the acquisition of G4S last year, we became a global leader in the security space. And as part of that acquisition, we've pivoted our strategy on a more global basis. So today we're over 90 countries, which gives us a plethora of new markets to hunt for deals in. As it relates to advisors, we have started proactively looking for firms that could deliver that global capabilities to us to kind of augment our domestic partners. So some firms have direct subsidiaries, some affiliates, others have loose partnerships, but that access to global advisory is increasingly important to us. So not surprisingly, we found that multi-deal relationships with key advisors and diligence resources save us a lot of time and money. So we worked with a handful of accounting, legal, insurance, IT vendors for a number of years on many deals. So having these teams learn our process, understand how we do things saves, again, a lot of money and time. So taking our business globally is quite a big change for us.
Thank you.
Maybe if I may add here on advisors, what I've seen, and it's I think partly or mostly driven by the activity that's coming from financial sponsors, is that they use a much wider spectrum of advisors than they used to. I mean, 10, 15 years ago, that would be financial advisor, legal, maybe commercial, and that would be probably it. Right now, you have an incredible level of fragmentation. And some of the bigger sponsors can hire a separate third-party advisor to cover each and every topic of due diligence. And sometimes when we have a list of participants in the VDR, you might have 200 people or even more working on a deal, and mostly third-party advisors.
Lukasz, just to stay with you for a minute, how are you seeing technology improving M&A, particularly around deal execution and productivity? What are deal makers doing with the time they're getting back from the improved efficiencies they're getting from tech?
Well, paradoxically, I don't think they're getting much time back, because I've done recently some analysis of how long the typical M&A process takes from the beginning to the end of the due diligence phase, and hasn't changed that much. So you have sort of 4 weeks plus 8 weeks in the second round. I think that due diligence, as I mentioned, is much more detailed, and people move quicker on certain topics, but there are just more topics. I think there's much more scrutiny coming from limited partners and investment committees within the financial sponsor community, and also shareholders and boards at corporates, that they want to make sure that the money spent on M&A is spent well. And that increases demand for more detailed due diligence. And then the deal teams actually need to deploy it. And then through the use of technology or advisors, they do that in processes, and it takes them exactly the same amount of time. Now, how they do that, what I've seen recently is incredibly interesting, and I think this is the way forward, is the use of AI and data mining and trying to analyze very detailed micro trends within a company, and then and identify those trends that would then support the equity story and the sort of unique selling points on the sell side, and on the buy side would give the reason for the buyer to pay premium price. And there are specialist teams that do it, that analyze this data and then repackage it so that it could be easily analyzed. And I recommend it to my clients, and I think that will be becoming more and more common in various sectors.
Lukasz, thank you. We're just a reminder, we're interactive. I'm already seeing some really intriguing questions coming in, and I wanted to ask a question to both of you, and maybe we'll start with Mike. This is from John Loser, who's asking, at what point in the M&A life cycle is the ideal time, do you think, to start formal and informed integration planning? Mike, maybe we'll start with you.
Yeah, sure. So the integration planning starts at the very beginning. Our process and the way we approach M&A from a corporate standpoint, it comes with very close collaboration with ops. And ops are critical, right? The ops and our teams on the ground, they know their local competitors, so they help you source the deals. They help you execute, right? They know everything about their competitors, their customers, how good they are, their reputations, and critically with integration, right? Once the deal is complete and we hand over the acquisition to our local teams to integrate, they have to be prepared. If you separate M&A from the operations and you develop a thesis and you develop a synergies plan without the local operators that later get to execute it, you're not going to have a good outcome. Because if you hand over something and the local guys might look at you and say, you're out of your mind, that's we can't achieve these synergies, or the synergies in a completely different place, you haven't done your job correctly. So partnering with operations early in the process and having them involved in this integration and integration planning is critical. So day one, literally day one.
And I couldn't agree more with Mike. And the way I do it when I advise on selling a company, and there are buyers who might have synergies, is to convince them from the very beginning that they should look into it. They should assess the scope of the synergies and try to quantify them and qualify them early in the process, because the seller will only get paid for a part of it, the bigger the better, if the buyer believes that they are achievable and that they can extract them with limited integration costs. If it's just a very high-level idea on paper, then no one will include that in the valuation. The more conviction the buyer will have that these synergies are real, the more of it will then go into the final price. So the earlier you start, the better.
And frankly, by the way, having transparency with the potential targets of what the synergies might be, how they could be achieved, where they come from, also creates quite a bit of trust, because those teams, those management teams will become part of your organization. So to spring a new idea on them, without their buy-in or input is also quite challenging. So for us, we believe in that transparency early, both with our teams and with targets.
That makes sense. That sounds critical. I also want to ask a question from Srinidhi Bharadwaj. We touched on this a little bit earlier, but can we elaborate on how data and analytics plays a role in diligence, either on the buy side or the sell side? Maybe start with Mike on that one.
Sure. So, look, if you're talking about speed of M&A and capacity and capability to do the work that we just discussed earlier, data is critical. It used to be financing, and deal-specific financing was the longest part, right? The long pole in the tent that would take the longest period of time. Now that, for us, frankly, we have sufficient liquidity to do most deals without deal-specific financing, it's all about seller prep, right? And that comes, frankly, with how good of an advisor they have, right? Can they move quickly? Can they prepare the data? Are they willing to share it? And are they willing to kind of present it and have the sophistication to deliver to us what we need? And for us, it's fairly simple, right? We buy companies of a certain cut. We know exactly what we're looking for, and advisors that sell us businesses know what we're looking for. So it's kind of the seller prep and seller organization and creation of their data set is critical. And by the way, that spectrum of preparation is very broad. We see folks with great advisors and great data, and all the way on the other end where the prep is not there. And frankly, that just means we're going to have to take a lot longer, spend more money internally, and potentially not deliver the valuation that the buyer expects, the seller frankly expects.
And I think when you want to touch upon the particular item of data analytics, I think the prep is super important here, because when you're selling a company, the last thing you want to tell the management is to give the most detailed sort of a data cube that's coming out of the ERP system into the buyer's hands, especially if you're running an auction and you have more than one buyer. So and you know that the buyers will want it because they want to run those funky analysis. So the way we do it is we want to hardwire it much earlier, and we use the sell-side advisors to look at the data cube in complete confidentiality vis-a-vis the buy side. They go through it. They try to separate the right trends, and then the outcome of this analysis is then used across the whole marketing material suite, starting with the teaser through info memo, management presentation, expert sessions, and so on and so forth. And then there might be some specific questions on the buy side related to some additional analysis that can be then performed upon the request. So, being diligent and being detailed early on in the prep phase, that can allow you to manage the buyer universe much easier, and the buyer dynamics.
Thank you. Question for Mike. What kinds of factors affect your company's productivity or efficiency when you're working on a deal? What do your company's internal M&A processes look like?
Yeah, so again, two major factors, and we touched on them both. One is seller preparedness, and it helps, and I can't overemphasize how critical that is, not just for the sellers, but it eliminates surprises, right? Often sellers have a number in mind with their set of financials, and once we dig in, we find things that they didn't know about, right? And it obviously requires quite a bit of adjustment and expectations. But as I said, our internal process and the speed of our execution is all about partnering with our ops early. Having them involved, having their buy-in early and throughout the process is critical. So those two things, how prepared the sellers are and what our local teams are willing and ready to do. And that's frankly part of the culture we try to foster in our organization, that M&A is part of our DNA. Folks have day jobs, and M&A is part of their day job. It's not just running operations, but helping and advising our team with sourcing of the deals, execution and diligence, and integration. So those two things, I would say seller preparedness and partnering with ops.
Thank you. We have so many great questions coming in. We don't have a ton of time. I wish we could get to everything, but I do want to make sure that I ask a question that came in from Akshay Grover about cybersecurity. How do you assess the cyber risk from an acquisition, and what approach do you take to mitigate it? Maybe we could start with Lukasz on this one.
Well, I have to say that when you look at the sellers and buyers these days, most of them don't recognize this as a risk. There's a ton of education now taking place from different parts of the sort of advisory world to bring this issue to the forefront, and that this is an example of a potential risk that needs to be due diligence. And there are also ways of how this could be mitigated, even through some insurance products. But people don't think about it. It's rather strange, given the geopolitics and so on and so forth, and the threat of cyber terrorism. So I think there's still a way to go. There are products now, both on due diligence and insurance side, that can cover that. But I have to say that this is something that the buyers still leave for the last moment of the due diligence process, or they don't pay too much attention to, and they should.
I would say it's rarely a value determinant factor. It's sometimes, in a rare instances, it's a go, no go decision, right? If it's viewed as a critical threat to the broader organization, and this acquisition could be used as, some global backdoor, that could mean a no deal. But rarely do you factor it and, as part of the risks and take it into account as an evaluation scenario. Cybersecurity risk, we have it as an organization. Every company we buy will have it as their organization. So all we can do is, post-acquisition, is to implement best cybersecurity practices that we have advisors to help us with. But, as I fully agree, it's often not, front of mind type of an issue.
Great. Cross-border deals. Mike, what can an acquiring company do to manage any concerns that it might have about foreign owners taking control of a local company? Want to hear from you both, but let's start with Mike.
Yeah, so given the labor intensity and critical nature of the work that we do, regulation plays kind of a big role in our industry. And, being a global leader, there's quite a bit of focus on kind of all domestic and international laws. When rules are fairly and equally applied to everybody in a particular geography, we know we can win, and we gladly compete, and more importantly, we gladly invest in those geographies. However, that said, we have absolutely come across a number of fairly restrictive kind of local regimes and regulations that favor local operators. And unfortunately, these regulators stifle FDI and prevent us and other global players like us investing in these otherwise pretty attractive markets. So, at the end of the day, given that capital is limited and global opportunity set is broad, we simply allocate our time and resources in places where we know we don't have an unfair advantage against local players. So it's absolutely a factor, and quite frankly determines which markets we hunt in.
Well, I agree, and it's a global phenomenon, right? I mean, wherever you look, whether it's US or Europe, you have increased scrutiny and focus on an attempt to control FDIs and control especially the nationality of the investor who is supposed to invest into the so-called strategic sectors. And in most cases, it just creates an administrative burden you need to go through. I recently looked at the European Union and UK data. I would say less than 5% of deals that are being reviewed actually go into phase 2 or are blocked. So this is very small. But if it happens, then it's a big issue. It might impact the transaction. So what I would again advise buyers to do, and also the sellers to be prepared, is to, when you look at your buyer universe, try to look at it through that lens as well. Which of them could have an issue, and pre-clear it sometime, or ask the buyers to pre-clear it with the regulator, whether this particular acquirer will cause any issues or not. And in situations where you have a consortia, maybe made of financial investors, where somewhere in the back, in a passive position, you have a 25% investor from a country that's not welcome. Make sure that in that consortium you have a shareholder agreement that has a toggle to switch off the governance rights for that particular investor, or an ability to replace them in the structure and provide alternative funding so that the deal can still go through. So again, think of it early on, get ready, and make sure you are in a dialogue with your buyers to make sure that they're doing the work as well, to limit the risk between signing and closing, that the deal may be called and then potentially blocked.
Thanks, Lukasz. Time for one more question about environmental, social, and governance. I want to start with Mike. Mike, how does your company think about how the ESG priorities of an acquisition target are going to align with yours. And maybe you can both tackle this one too.
Yeah, so look, ESG is critical. We take it very seriously, and it's a big part of our process. We have to think about each deal, kind of if and how it fits into our broader business, if and how it will cause ESG concerns, or frankly, on occasion, alleviate some of the existing issues that we have. You know, we produce an annual ESG report that we share with our investors. A lot of our customers ask for that report and review it and ask us questions. So it's available to the public as well. So it's always in our mind. And again, we operate in a business that's heavily regulated. How we interact with our labor, you know, how we hire, recruit, train, uniform, deploy, pay, compensate, communicate with our labor is highly regulated everywhere. So staying on top of these regulations, and as changes come in, as other things happen, it's a big part of what we do, having the regulatory and compliance departments to keep track of these things. And frankly, that's one of the reasons why our customers choose us often versus local companies, because they know we're religious about complying with these regulations and adjusting as the regulations change.
And I think that's a very good point, because, you know, for me, ESG these days is not only about ticking the box, due diligence, it's about value creation as well. And this is the indirect way of creating value. Because if you have the right ESG credentials and your customers want to deal with you because they are in the same, you know, frame of mind, that generates additional value, and this is good for business. So I think and people have started to realize that, and you know, even financial sponsors, when they look at an asset that they can acquire, they usually now have a certain ESG framework that they apply to all the portfolio companies, because they see that if they can make this certain changes through their holding period, they can sell the business later at the higher multiple that justifies the ESG credentials, and also to get financing these days from banks, but also you know, funds and lenders and investors. You have to be able to issue sustainability linked or green financial instruments, because this is becoming a market norm in the investment grade market, as well as in leveraged loans.
Okay, well, Lukasz and Mike, I wish we had another hour to keep talking about this. We've had a lot of great questions coming in. We are out of time, but this has been a great conversation. I want to thank all of you for joining us today, and especially for participating in the survey. Thank you especially to Mike Beregovsky from Allied Universal and Lukasz Dziarnowski from BNP Paribas. Thanks also to Alex Clemente from HBR-Analytic Services. Our producer today at HBR is Caitlin Emmerin. Thanks to her and to our partners at On24, and of course a big thanks to DataSite for making this discussion possible. This concludes our presentation. Have a great day.
Thank you.